Hi, I'm Gavin Correa, Managing Partner at LCA and host of the Free Accounting Clinic for Entrepreneurs at Yes. In this video series, we're going to outline some of the financial, tax, and accounting considerations when starting a new business. The first video is going to explore the advantages and disadvantages of incorporating your business and the factors to consider. The subsequent videos will break down government filing requirements and major business-related tax deductions and expenses. So, you have a business? Everyone keeps talking about incorporation, and you are wondering what it means to incorporate. Well, there are many different aspects. By definition, registered corporations have a legal personality, and their shares are owned by shareholders, whose liability is generally limited to their investment in the corporation. In other words, you cannot be held personally responsible for any liability or action of a company. Shareholders do not typically actively manage a public corporation. Shareholders instead elect or appoint a board of directors to control the public corporation in a fiduciary capacity, such as a famous company we all know about, Apple. However, the purpose of this presentation is to discuss private corporations. Specifically, this means that any person can go and incorporate a company, issue shares, and commence the lifespan of a corporation. Now this legal entity starts to breathe and can start to transact, open up bank accounts, sign contracts, and purchase assets such as buildings and stocks and inventory. It is a separate legal entity. You may be the owner of the shares, but it is a separate entity from you. In most circumstances, a shareholder may also serve as a director or officer of a corporation. All legal liability of a corporation rests with the corporation and does not necessarily spread to a shareholder, except when a shareholder personally signs, for example, for a lease, a bank loan, or a personal guarantee. Also, all sales taxes and payroll taxes potentially owned by a corporation are the responsibility of the director, or in many cases, the shareholders. Taxation is another major advantage of a company. In Quebec, the corporate tax rate combined is approximately 18%. This is a major advantage compared to other jurisdictions in North America. This allows you to pay less tax in the company and use the savings to reinvest in your business over time. Once you withdraw funds from the company, the dividends become taxable to the shareholder. So the ideal plan is to leave funds in the company and build the equity or its retained earnings. The cost to incorporate is approximately $1,000 to $1,500 and depends on whether you would prefer a Quebec jurisdiction company or a federal company. Also, if you would prefer a name to your company as opposed to a numbered company, a name search would cost a little more. All in all, the maximum would be about $1,500. The cheapest way to get incorporated is to handle the process yourself, but it can be a daunting task. Normally, you would use a lawyer to incorporate a company or your accountant. There are also websites that you can use to get going, such as Incorp Direct, Incorporation Pro, and yes, Shopify. We've included links to these websites in the description below. Ongoing filing fees will depend on the jurisdiction, but annually less than $100 in corporate fees. However, you must file corporate tax returns on an annual basis. This would require you to engage an accounting firm to prepare financial statements and corporate tax returns. This is another needed cost in the range of $1,500 to $2,500 for a basic company. Another major advantage of a company is that the company can directly own life insurance and designate a shareholder as a beneficiary. Therefore, the company can pay the premiums and the state can be the beneficiary of the policy without paying for the premiums. Any life insurance proceeds will flow directly to the corporation to the shareholder's estate. Shareholders' agreements are generally a good idea wherever you have a company with more than one shareholder. The legal fees associated with the preparation of the shareholders' agreement vary in direct proportion with the complexity and comprehensiveness of the agreement. It is very important to weigh these advantages with all costs of incorporation and to discuss all relevant issues with a professional. The rule of thumb is that if you personally need all your business earnings to make ends meet, then it is not worth it to incorporate, for now. If you still need help, be sure to contact the coaching services at Yes. Also, for more tips and information on how to run a small business, check out the Yes YouTube channel.